Gary DeWaal here, and this is Bridging the Week for October 19th to 23rd, and today is October 26th, 2015. Good morning. Last week, leaders of major regulatory agencies in the United Kingdom and the United States expressed concerns about at least some aspects of the post-2007-2008 financial services regulatory environment, while Prudential regulators began rolling out a final rule on margin requirements for uncleared swaps. Europe set its clocks back an hour on Saturday night, so we presumably have more time for our articles today. But there's a lot to cover, so let's get started. In two speeches last week, Timothy Massad, chairman of the Commodity Futures Trading Commission, said the agency is currently considering proposals to mandate various pre-trade risk controls for automated trading, as well as requiring registration for proprietary trading firms that are not already registered with the Commission. According to Mr. Massad, the proposals related to pre-trade risk controls would apply to firms engaged in automated trading whether the trading was quote-unquote high or low frequency. The CFTC would not attempt to prescribe the parameters for risk controls, but solely require certain types of controls that will mostly be, quote, consistent with the best practices already followed by many firms, end of quote, noted Mr. Massad. Among the types of pre-trade risk controls being considered by the Commission are message throttles and maximum order size limits, said Mr. Massad. He also indicated that the Commission is considering requirements related to the, quote, design, testing, and supervision of automated trading systems, end of quote, as well as measures to limit unintentional self-trading. Mr. Massad did not provide an expected date for any proposed rules, and in fact emphasized that, quote, the Commission has not yet decided to issue any proposals, end of quote. Similarly, at one of the forums where Mr. Massad appeared, Mary Jo White, chair of the Securities and Exchange Commission, likewise said that the SEC is considering proposals to strengthen risk controls for firms using algorithms, develop standards dealing with the, quote, use of aggressive destabilizing trading strategies by active proprietary traders in vulnerable market conditions, require registration for certain active proprietary trading firms that are not currently required to be SEC registered, and increase the operational transparency of non-exchange trading venues. Separately, in one of his speeches last week, Mr. Massad lamented the failure of European regulators to date to recognize U.S. clearinghouses as subject to equivalent regulation as European clearinghouses, and of banking regulators to permit banks to consider client collateral posted at clearinghouses in connection with their cleared derivatives as an offset against the bank's exposure there for the purposes of calculating their so-called supplemental leverage ratio. Without an equivalency recognition, European banks will likely have to incur substantial extra capital charges to clear trades on U.S. clearinghouses, while most banks will have to incur extra capital charges if offsets are not recognized for cleared positions. Last week, two Prudential regulators, the Office of the Comptroller of the Currency and the Federal Deposit Insurance Corporation, announced their approval of a final rule governing margin requirements for so-called covered swap entities in connection with their uncleared swaps. In general, the final rule addresses when, in connection with uncleared swaps, covered swap entities must collect from and post with their counterparties initial and variation margin, initial margin calculation methodologies, eligible collateral that may be used to meet margin requirements, and the treatment of collateral posted as margin. Non-financial end users are expected to be exempted from mandatory margin requirements under a related rule, but covered swap entities will be authorized to collect margin from such counterparties consistent with their overall credit risk management. The Board of Governors of the Federal Reserve System, the Farm Credit Administration, and the Federal Housing Finance Agency will also formally approve the new rule, which is mostly consistent with the proposed rule governing margin requirements for uncleared swaps issued by the five Prudential regulators in September 2014. Tracy McDermott, acting chief executive of the UK Financial Conduct Authority, acknowledged that, quote, the intensity and volume of regulatory authority over recent years is not sustainable for regulators or for the industry, end of quote, in a speech delivered last week at the annual City Banquet at Mansion House in London. Ms. McDermott acknowledged that if boards of financial service companies continue to spend the, quote, majority of their time on regulatory matters, we will crowd out the creativity, innovation, and competition which should present the opportunities for growth in the future. End of quote. In Ms. McDermott's views, it is appropriate to reevaluate all regulatory changes that have been implemented after a crisis, such as the financial crisis of 2007 to 2008, as, quote, inevitably among the many good and rational changes that arise, there will be some that don't have the intended or expected impact, end of quote. However, she cautioned against too many changes, lest the, quote, pendulum swing too far in the other direction, end of quote. 5 regulators, including the U.S. Department of Treasury and the Board of Governors of the Federal Reserve System, settled charges against Credit Agricole for allegedly engaging in prohibited transactions between 2003 and 2008 with countries and entities subject to U.S. financial sanctions. The countries included Sudan, Iran, Myanmar, and Cuba. According to the regulators, Credit Agricole allegedly agreed to clients' requests to disguise their identities in transactions in over $32 billion of U.S. dollar payments processed through its New York branch and unaffiliated U.S. financial institutions, as well as to engage in sanction violations on their behalf. To resolve this matter, Credit Agricole agreed to pay $787 million in total penalties and the imposition of certain undertakings. And finally, BNP Paribas Securities Corp., a Futures Commission merchant registered with the Commodity Futures Trading Commission, settled charges brought by the agency that, on 3 dates in 2014, it violated rules restricting the amount of customer funds it could lawfully invest in money market funds. These rules prohibited FCM from investing more than 50% of all customer funds in money market funds generally, and 10% of customer funds in an individual money market fund. On 2 of the occasions, the error was caused by clerical entry mistakes, while on the other occasion, the error was caused by a failure to detect an investment percentage overage, said the CFTC. BNP agreed to pay a fine of $140,000 to resolve this matter. It also agreed to, quote, regularly review its policy and procedures and to provide training to ensure compliance with applicable regulation, end of quote. In accepting BNP's settlement, the CFTC acknowledged that no customer sustained losses as a result of BNP's alleged violations and recognized, quote, BNP's cooperation during the investigation, end of quote. Well, that's it for this week's edition of Bridging the Week. As always, there is more information in each article and more articles on the article version of Bridging the Week on the website. Check it out. Next weekend, North America advances its clocks. Until then, have a great week, have a good time, and as always, ciao.